You understand? Stock market, all you should know about the stock market. Now let's go down to definition. What is a stock market? A stock market or equity market is a public entity for the trading of company stock, that's shares and derivatives, at an agreed price. These are securities listed on the stock exchanges, as well as those only traded privately. The stock market are listed and traded on stock exchanges, which are entities of a corporation or mutual organization. The largest stock market in the United States by market capitalization is the New York Stock Exchange. Now, stocks. What are stocks? At some point, just about every company needs to raise money. In each case, they have two choices. They either borrow money or they raise money from investors by selling them a stake, issuing shares or stock in the company, like selling portions of the company to investors, and those investors are the public. Anybody can be an investor. You understand? Right. So by investing, you are buying parts of the company. Yeah. Why you should own a share? When you own a share or a stock, you are a part owner in the company with a claim, however small it may be, on every asset and every penny in earnings. Individual stock buyers rarely think like owners, and it's not as if they actually have a say in how things are done. Nevertheless, it's the ownership structure that gives a stock its value. Stock exchange. What are stock exchange? A market in which securities are bought and sold. Securities here means stocks. The company was floated on the stock exchange. The initial offering of stocks and bonds to investors is by definition done in the primary market, and the subsequent trading is done in the secondary market. The primary market is like the banks. There's what they call initial public opening. When a company declares that they want to start selling stocks, then the stocks are available at the primary market. You understand? So the people in the primary markets are banks, big organizations, stock exchangers. They will buy the stocks from the company. Then now we will be buying from the secondary market, which is we are buying from the banks that bought the stock initially, or from the companies that bought the stocks initially. So we buy from the secondary market, like we buy through brokers. All of us are buying, we are buying from the secondary market. A stock exchange is often the most important component of a stock market. Supply and demand in stock markets are driven by various factors that, as in all free markets, affect the price of stocks. Role of a stock exchange. Raising capital for business. Common forms of raising capital: going to public, limited partnership, venture capital, corporate companies, mobilizing service for investors. These are roles of a stock exchange. Stock exchangers. Major stock exchangers: Economic Stock Exchange, US and Europe, New York Stock Exchange, US and Europe, North, and so on. Stockbrokers. Now, this is a very important part of the lesson today. Stockbrokers, an agent that charges a fee or commission for executing buy and sell orders submitted by an investor. You understand? Like the stockbrokers who have different types of stockbrokers, different kinds. Like in the United States, we have the Robinhood, we have AD Emirates, we have Webull, we have different kinds of stockbrokers. So now there are the people that execute the orders. Like you want to buy, you click your buy, they will execute the buy order. You want to sell, you click your sell. Their responsibility is to execute the orders that you click on their app. You understand? A firm that acts as an agent for a customer, charging the customer a commission for each service. You can either opt for a conventional broker or you can choose to trade online. If you are trading online, you can get the broking service from the banking or non-banking organization offering online trading facilities who will provide you with the DP account and acts as your broker. Understand? Stock advice, general market advice. Now, these are some things you need to consider before going into stock trading, before buying and selling stocks, before investing in stocks. Never chase a stock. Buy when markets are in the grip of panic, like when prices are low. Only buy fundamentally strong stocks which are undervalued. Okay? Do not buy like any company you see. You have to check their market capital. You understand? You have to check the strength of the company because some companies can disappoint you. So before you buy from good companies. Buy stocks grown in top line and bottom line over the past years. I hope you understand. Invest in companies with proven management. Companies like Tesla, Apple, Google, Amazon, name them. Different kind of companies, Coca-Cola. These companies have been there for so long, and they have proven results. So you can check out on them before you invest. And which has a good management. Avoid loss-making companies. PE ratio and growth in earnings per share are the key. Look for the dividend paying record. Some stocks, they will have two types of stocks. We'll have the dividend stocks and the growing stocks. Dividend stocks, like they pay you like a profit, like maybe at the end of a year, they will calculate the profit for the year, then they will share the profit. That's called dividend. Then growing stocks. These are companies that are growing. They don't pay out dividends. They rather reinvest the profits into the company. You understand? Invest in stocks for sure returns. Stocks have been the high yielding. Stocks are an asset class. Stocks that are an asset class. The basic property of any asset class is to grow. Buy when everyone is selling and sell when everyone buys. Hope you understand. Buy when everyone is selling and sell when everyone buys. Invest a fixed amount each month. This is like an investment. You have to keep investing to get more out of it. You understand? Because if you invest maybe $100 and somebody that invests $1,000, your profit is never the same. If you invest $10,000, your profit with the person that invested $1,000, they can never be the same. So the more you invest, the more profit you make. That's how the stock market works. These are some things to consider, the things you do and the things you don't do. What you must do. Get rid of the junk diversify. Believe in your investment. Stick to your strategy. You have to have a strategy, investment strategy, and you stick to it and make sure your strategy is the right one. What you must not do, don't panic. Even though when the stock prices are going down, you don't panic because they must surely rise up again. You understand? So don't make huge investments. Invest accordingly. You have to invest and do other things. You understand? Don't chase performance. Most times you don't chase performance. Don't ignore expenses. Thank you. Thank you. Yeah. Thank you, everyone.